1999. You wake up, check your portfolio, you're a millionaire. Buy lunch, 2 million. You didn't do anything. You just own shares in a company that sells dog food online. Your neighbor quit his job to day trade. Your dentist is launching a startup. Everyone's getting rich, and the only requirement is having a pulse and an internet connection. Then March 10th, 2000 hits. $5 trillion evaporates in 2 years. Millionaires become broke overnight. Companies worth billions become worthless. The craziest part? Everyone saw it coming, and nobody stopped. Let's go back to where this madness actually started. 1991. The internet goes public. Not exciting yet, just universities and nerds sending emails. But then Netscape launches in 1994, the first real web browser. Suddenly, regular people can click around the internet. It's slow, it's ugly, but it's new. Netscape goes public August 9th, 1995. Stock opens at $28. By end of day, $75. The company wasn't profitable, didn't matter. Investors saw the future and threw money at it. That single day rewired every brain on Wall Street. Profit, old thinking, revenue, boomer mentality. The new rule: traffic equals value. If people visit your website, you're worth billions. Doesn't matter if you sell anything. Amazon launches 1995. Loses money every single quarter. Stock goes vertical anyway. Yahoo? Same story. Burning cash, stock soaring. eBay, AOL, Priceline, all the same pattern. And Wall Street's eating it up because they'd never seen anything like this before. Here's what made this different from every other investment bubble in history. Normally, you need expertise to invest. Want to buy real estate? You need to understand property values, locations, zoning laws. Want to invest in oil? Better understand commodities, supply chains, geopolitics. But the internet? Nobody understood it. Your banker didn't understand it. The CEO didn't understand it. That confused 70-year-old investor? He definitely didn't understand it. And that became the edge. If nobody knows how it works, nobody can tell you you're wrong. Pets.com launches 1998. They sell dog food online and ship it to your house. Here's the problem. Dog food is heavy. Shipping is expensive. Margins are razor thin. A 10-pound bag of dog food costs them $12 to ship, sells for $11. They lose money on every single sale. Investors? Don't care. Pets.com goes public February 2000. Stock hits $14. Market cap, $300 million. For a company that loses money selling dog food. Their marketing budget? $60 million in 1 year. More than their entire revenue. They bought a Super Bowl ad. Cost $2 million for 30 seconds. The company had existed for 2 years. But that's not even the most insane part. Webvan wanted to replace grocery stores. They'd deliver your groceries in 30 minutes. Sounds convenient, right? They raised $800 million, built giant automated warehouses, hired thousands of drivers, spent $1 billion total. They never figured out how to make a single profitable delivery. Bankrupt by 2001. Cosmo.com promised free 1-hour delivery for anything. DVDs, snacks, magazines, whatever. No minimum purchase, no delivery fee. You could order a single pack of gum, and they'd send someone on a bike to deliver it within an hour. Investors gave them $280 million. The math never worked. They went bankrupt 2001, laying off 1,100 employees in 1 day. Meanwhile, something fascinating's happening with regular people. Your accountant from Nebraska, who's never bought a stock in his life. He's online trading tech stocks. Quitting his job because he made 50 grand in a month clicking buttons. Day trading becomes a profession. People rent office spaces, set up multiple monitors, trade all day. They're not investors, they're gamblers. But when everything goes up, everyone looks like a genius. CNBC becomes the most watched channel in America. People leave it on all day watching stocks tick up. Jim Cramer's screaming about which .com to buy next. Everyone's got a tip, a hot stock, insider information that's actually just rumors. Here's the feedback loop that breaks reality. Company announces literally anything. Stock jumps. That jump attracts more investors. More investors push the stock higher. Higher stock means company can raise more money. More money means bigger announcements. Bigger announcements mean stock goes higher. It's a spiral that only works in one direction, up. TheGlobe.com goes public November 1998. Opens at $9. Closes first day at 63. That's a 606% gain in 6 hours. The company ran a social network and lost money. Nobody cared. Analysts start creating new metrics because old ones don't work. Forget earnings per share. That's ancient history. New measurement? Eyeballs. How many people visit your site? Clicks, page views, user engagement. None of it translates to money, but it sounds important. Price to eyeballs ratio becomes an actual thing analysts discuss seriously on television. Companies go public with zero revenue. Not low revenue, zero. The business plan is literally: Step 1, build website. Step 2, get users. Step 3, figure out money later. And it works. Investors flood in. By 1999, you don't even need a finished product. Just a decent website and a .com domain. Announce you're pivoting to internet? Stock doubles. Add .com to your name. Instant 20% jump. Books are written about the new economy. Old rules are dead. This time is different. Profitability is outdated thinking. We've reached a new paradigm where growth matters, revenue doesn't. Alan Greenspan, chairman of the Federal Reserve, warns about irrational exuberance in 1996. The market ignores him and keeps climbing. He's watching this bubble inflate and can't pop it without crashing everything. The NASDAQ index tracks tech stocks. January 1995, under 800. March 2000, over 5,000. That's a 539% increase in 5 years. But something's shifting beneath the surface that nobody's noticing yet. These companies are burning through cash faster than they're raising it, and there's only so many times you can go back to investors asking for more. March 10th, 2000. The NASDAQ hits 5,048. The absolute peak. Nobody knows it yet, but the clock just started ticking backwards. First crack appears quietly. A few companies miss earnings. Stock drops 20–30% in a day. Analysts say it's healthy correction. Buy the dip. Smart money's already heading for the exits. Then the dam breaks. April 2000. Microsoft loses antitrust case. Investors panic. Tech stocks start falling. Not correcting, collapsing. Pets.com, the company that spent millions on a sock puppet Super Bowl ad? Stock falls from $14 to 19 cents. They shut down November 2000, 9 months after that commercial aired. Webvan, the grocery delivery dream, spent $1.2 billion building infrastructure. Bankrupt July 2001. All those warehouses, all those trucks, all that technology, worthless. eToys actually had revenue, $300 million in sales. Went bankrupt March 2001 anyway, because they were losing money on every single sale. Turns out shipping toys costs more than people will pay. The pattern repeats everywhere. Boo.com burns through $130 million in 6 months selling clothes online. Bankrupt May 2000. Cosmo shuts down April 2001. All those bike messengers delivering single candy bars? Gone. Here's what nobody saw coming. These companies are connected. When one fails, it takes others with it. Webvan's bankruptcy destroys their technology provider. That provider's failure hits their investors. Those investors pull money from other startups. Everything's linked. Layoffs start. Thousands at first, then tens of thousands. Those day traders who quit their accounting jobs, they're trying to get those jobs back. Except those companies just froze hiring because the economy's tanking. San Francisco empties out. Office spaces that cost $8 per square foot in 1999. $2 by 2002. Entire buildings sit vacant. The parties stop. The ping-pong tables get sold. The free snacks disappear. NASDAQ loses 78% of its value from peak to bottom. $5 trillion in market value just evaporates. That's not a number. That's retirement accounts, college funds, people's entire savings. Regular investors get destroyed. Your Nebraska accountant who made 50 grand day trading? He gave it all back plus his original investment. He's not alone. Millions of people discovered they weren't genius investors. They just had a good seat on a rocket ship. And nobody mentioned the rocket had no fuel. The companies that survive do something revolutionary. They focus on actual business fundamentals. Crazy concept. Amazon nearly goes bankrupt. Stock falls from $106 to $6. Jeff Bezos cuts costs, fires employees, focuses obsessively on making money per transaction. It works. They survive. Google launches 1998, goes public 2004 after the crash. They wait until they're actually profitable. Novel idea. Their IPO raises $1.9 billion and the company's making money. Imagine that. eBay survives because their model actually works. Taking a cut of transactions between users costs almost nothing and scales perfectly. They're printing money while everyone else is burning it. But most don't make it. 52% of dot-com companies that went public between 1996 and 2000 are gone by 2004. Not struggling, gone. Bankrupt, acquired for pennies, dissolved completely. The psychological damage runs deeper than the financial damage. An entire generation of investors learns to fear technology stocks. Venture capitalists become terrified of consumer internet companies. The pendulum swings from irrational exuberance to irrational terror. It takes 15 years for the Nasdaq to recover to its 2000 peak. 15 years. Anyone who bought at the top and held. They waited until 2015 just to break even. And that's not accounting for inflation. Total estimated losses. $5 trillion in market value destroyed. Countless jobs eliminated. Dreams shattered. Families bankrupted. All because everyone forgot the most basic rule of investing. A company needs to make money eventually. The dot-com bubble teaches one crucial lesson that everyone immediately forgets. Hype is not a business model. Growth without profit is just expensive failure. And this time is different are the 4 most dangerous words in investing. Here's the part that should terrify you. We didn't learn. The exact same pattern repeats 2008 with housing. Banks lending to anyone with a pulse. Prices climbing forever. This time is different. Then collapse. Happens again 2017 with crypto. Bitcoin to 20,000. Everyone's a genius. This time is different. Then 80% crash. Happens again 2021. Meme stocks, SPACs, NFTs. People quitting jobs to trade GameStop. This time is different. Then reality returns. Every bubble looks obvious in hindsight. But during it, you're the crazy one for not buying. You're missing out. You don't understand the new paradigm. The dot-com crash proved something dark about human nature. We see the pattern, we know the history, we understand the cycle. And we do it anyway. Because maybe this time really is different. Except it never is. Those sock puppet commercials, the Super Bowl ads, the pinball machines in lobbies. They weren't signs of success. They were symptoms of a disease. Spending money you don't have on customers who don't exist, selling products that don't make profit. The bubble didn't burst because of one event. It popped because reality is patient, but inevitable. You can ignore math temporarily, but math never ignores you. Eventually, the bills come due. They always do. 20 years later, those same investors are funding companies that lose billions delivering food. Same pitch, different app. Venture capital pouring into businesses with no path to profit because growth looks impressive on a pitch deck. The dot-com bubble didn't teach us to avoid bubbles. It taught us we're terrible at recognizing them while we're inside one. Right now, someone's building the next pets.com. Someone's investing in it. Someone's convinced this time is different. Except the math hasn't changed. Revenue minus costs needs to be positive eventually. Hype doesn't pay salaries. Eyeballs don't cover rent. And when the music stops, there's never enough chairs. The wildest part? $5 trillion vanished. Millions of people lost everything, and the main lesson we took away was wait 15 years and try again. Because that's what we did. Housing bubble, crypto bubble, meme stock bubble. Same story, different assets. You're watching it happen right now. Just different names, different technology, same delusion. The only question is whether you'll recognize it before reality does.